Hi, everyone. Just to say, I wasn't here this morning. I only arrived at just after lunch, so I'm sure this topic of FASTA has probably come up a few times today. But Ali and the team at Schuska rightfully thought today's proceedings couldn't go ahead without some further discussion on FASTA. A substantive European directive that is, fair to say, going to change the face of European withholding taxes over the next few years. And we come in today straight off the back of a pivotal decision, the ECOFIN approval last month. So this felt like a very natural time to have a discussion about it. So we're going to spend the next this is in contention, 45 minutes. Ali did try and extend it to an hour and a quarter. So somewhere in the middle, it's very unlike Ali, talking about some of the questions, issues, benefits, challenges, etc. We think the directive looks as though it's going to be bringing so far. I'm going to introduce my panel, and I feel after, what was the gentleman's name? I've forgotten already, the technology person. He gave such a grandiose introduction to his panel. I feel, Graham, I feel as though I'm underselling my esteemed panel, but that isn't what was meant. So we have with us, no panel is complete without the technical expertise of Steffen from WTS, Len Lipton from GlobeTax, Frederek Schuska from the European Commission, and Paddy Reidy from Capital Asset Management, and myself, Rebecca Willmott, JP Morgan. So just as a lead-in to today's discussion, I thought it might be useful to set a level playing field and just briefly summarise what we understand the genesis and the drivers behind the FASTA directive are and have been. It's not, I don't think, in huge dispute that the current withholding tax processes in general across Europe are deemed to be at times burdensome, costly, lengthy, and that's a large part due to the variation in requirements to date across member states. The result of that has been that the member states' view is the whole process, to a greater or less degree, is still prone to risk. And of course, that, amongst other things, materialises in a loss of revenue, critically for the member states. So it's a key priority. We also hear the opinions of the various jurisdictions in Europe that there has been a lack of transparency across the financial chain, and that's also a contributing factor to these concerns around the ongoing potential for tax abuse. We've all heard about I don't like this word, but tax scandals, whether it's div arbitrage schemes, CumEx, that short-selling activity that we saw and have seen going on around dividend distribution date to create confusion between economic owner, legal owner, and so forth, resulting in erroneous claims being filed. All of those concerns, which have been continually thematic over the last few years, are in part what's driven, as we understand it from the Commission, the genesis of FASTA. So FASTA is looking to harmonise, and I think we're probably all going to say this a few times today, and looking to standardise where possible. We've also heard, I thought, some shocking, surprising statistics along the way from the FASTA journey so far, which are helpful because they endorse, again, the purpose of FASTA. They estimate approximately 70% of retail investors are foregoing withholding tax relief that they would otherwise or should otherwise be entitled to, simply because the process is, as we've described, incredibly difficult at times, challenging, time-consuming. Many of you have probably also heard the figure of 6.62 billion euros, I think it is. That's the estimated cost of the process across the industry today. It's a staggering amount. So in my view, and I think we all agree, the Commission have made a point of emphasising continually through the FASTA journey so far that the intention is absolutely to continue to support the good functioning of the CMU, the Capital Markets Union, to continue to support the ethos of a single market, and of course, above all else, investment, and break down these perceived barriers that we've been talking about. So Frederek has kindly offered to start today's proceedings. We're very lucky to have him here from the Commission. Frederek, I think you're going to give us an overview. I'm not sure how familiar or not everybody in the room is of the key elements of the directive, maybe how it's changed from the first iteration to where we are now, and a look towards the future lens. I know we can't be absolute at this point, but as much as we know what's coming next in terms of priorities. Thank you.
Yeah, thanks a lot, Rebecca, and hello to everybody. Indeed, I think this structure is, I would like to take you on a journey to perhaps at the end everyone can agree if we have old wine in new bottles, or if we have really a progress in terms of removing obstacles regarding the withholding tax deduction, and then of course the relief or refund procedures. I think there are two important things at the very beginning you have to take into account. One thing is, where are we coming from, and what are the basic elements, or the elements, but what is the aim of the directive? And this is like a red line through the whole directive. First of all, the problem is not new. That we have obstacles in cross-border investments. There was already in 2002, or 3, the so-called Giovannini report. Then we had a recommendation of the Commission in 2009, where they also, at that time, a part of the capital markets rules that have to be changed, but also they took into account that also tax is an important part regarding that. And in 2017, we had a code of conduct which was issued by the Commission, where the member states should then digitalize the whole process and make it easier for the investors, because one of the most important points for retail investors is what also Rebecca said, and that we also had in the impact assessment, which you have to do before a directive can be drafted, is that many investors, they simply do nothing because it's too costly, too lengthy, the whole process. So, I mean, that this is not, or this is something which has to be removed when you have, when you want to ensure a capital markets union. I mean, this is for sure. And but all these kind of recommendations and code of conducts we had were non-binding. So the point is, then in 2020, we had the so-called action plan, which the Commission usually, when a new Commission is in place, there is for the next 5 years a so-called working plan, which you will see also, I guess, in the beginning of next year for the next term. And there also this kind of topic or issue was again mentioned. And but this is the one thing, and then the other thing is then to draft the directive. And I make it here briefly. We published then the directive 19th of June 2023, and the ECOFIN agreed on a so-called general approach now in May this year, so not so long ago, which was of course a huge success. We had 2 presidencies, so the Spanish presidency and the Belgian presidency, so everyone, or both had, I would like to say, their approaches in bringing that over the line. And I will introduce you, or I will mention what kind of changes we had now in the directive at the version 10 compared to the initial draft, or then initial proposal of the Commission in June, it was June 2023. So, but the overall aim is we have, and they are 50-50. So one, we want to enhance the cross-border investment. We want to make a huge step towards the capital markets union. And on the other hand, this is from the aims at least equally weighted, is tackling of tax abuse. And you can imagine that these 2 aims are a bit contradictory, because on the one hand, I mean, you can make it very effective, but then could be loopholes. On the other hand, if you have too many safeguards, then the whole system is not effective enough to reach the capital markets union at the end. So the main or basic elements of the draft in 2023 were, I would like to say, first, every member state has to introduce for tax purposes, like it is said in the directive, a electronic or digital tax residence certificate. And this is something when you think, okay, now we have 2024, shouldn't be so difficult, but there are member states, without blaming them, but they are still paper-based. So this is already this part, we thought it's a very important step towards a faster, and for the investors, no matter if retail or bigger investors, makes the life easier at the end. So this is one part, and then the other part, which is more or less the architecture of the directive. So Article 4 is ETRC, then Articles 5 to 9 is the registration obligation for large institutions. The definition we refer here to the capital requirements regulation. You see, you always have also the reference to existing capital markets law. So this is also something which is, on the one hand, makes it a bit difficult because tax and financial services laws have to, they have to fit together. But on the other hand, it's nothing new. So investors or company financial intermediaries more or less worked with that since years. I think the CRR is from 2013. We have other directives from 2014. So there is quite some years, and I think it's quite well known, I would like to say. But then this registration process is also for CRS, when they have tasks for withholding tax agents. So these two, I would like to say, types of players, they usually have the role in the dividend payment stream, and this is the important thing, because the registration is closely linked to the reporting, because the aim of the reporting is to have full transparency for the tax administrations from, I would like to say, the issuer more or less to the investor at the very end. So this is that you know what the idea is here behind, but to the changes I come later, because there is a significant change or amendment also here. And then we have the core element is the relief at source, which is well known, Article 12, and the so-called quick refund in Article 13, which is a bit different. But the quick refund, only to give you a certain indication about timing, the quick refund is now, I think we have 60 days. And before, usually you draft a directive, you have you do some surveys about, where's the problem and so on. And what we hear also from stakeholders, from investors, is that usually it even takes months or years that then if there is a refund system, not relief at source, but if there is a refund system, it takes such a long time. So hopefully, of course, if everything is then implemented and works well with the beginning of 2030, that we have here a significant change in terms of timing. And I think this is something where investors hope, of course, that they get their money back, which they are entitled to according to the double tax treaties, that it's much faster than now. So this is the one thing. And the second thing, perhaps, all the other elements, we have now then liability and penalties afterwards. And then at the end, usually, like always in directives, transposition dates. So this is the end. So I would like to say, in terms of, we have longer directives, but I think there is quite, if you go into detail, quite a lot of to transpose for the member states. And perhaps before, or should we take the first question? Because otherwise I would show you also indicate some changes we had in the last compromise text. Or should we take the question?
I just wanted to
Let
add
Steffen
something.
ask this question. He's desperate.
No. I just wanted to add that you are also foreseeing late interest payment.
That's right, yes.
Which in some countries, for example Germany, is not in the law. So there are significant advantages in this directive for the taxpayers.
That's right, yeah. And I can tell you that in the discussions or negotiations, of course, that was not so easy to that it stayed in the directive. So, but this is a very good point indeed. These late payment interests. This is something which we hope, at least, that then the tax administrations really rely on the timelines we have in the directive, and which must be transposed at the end. But as you as I said, then there are presidencies. Presidencies want usually a success as fast as possible, and then they have their priorities in terms of what they agree with then the member states. So you can see that we have significant changes which started already during the Spanish presidency, which was the second half of 2023. Because the first big change, I would say, is in the scope. Because now there were already changes at the end of the Spanish presidency, because smaller member states told us that we have an existing relief at source system, we don't want to change anything, and we have only a few cases per year. So, but then was the idea how to do that, because if you start with implementing some exemptions or carve-outs, however you will call it, then of course other member states come and also want something. So there you have to be careful, but I mean the idea was on the market, so to say, then we had to deal with it. And first was the idea to have that member states could be carved out if there is a so-called comprehensive relief at source system, which must be examined or at least confirmed by the Commission. But this idea was not, I would like to say, member states didn't like it very well. So that idea was fully deleted or scrapped at the end. So now, and then we introduced during the Belgian presidency what we have now. So we have two elements. First, you need a comprehensive relief at source system, and the second is a so-called quantitative criteria that you must have maximum 1.5% of market capitalization or below. And if these two criteria are fitted, then you could carve out of Chapter 3, which means registration and reporting obligations. And yeah, that was quite something I would like to say, which was difficult because every time, as I mentioned, if you begin with exemptions, then it's a loss of harmonization, this is for sure. On the other hand, you have to look at one figure, and this is very important. If you take the look on the market capitalization, now even if all member states which at the moment fulfill these criteria and they are out, 95% of market capitalization or member states, if you compare it, are still in. So all the big member states with bigger capital markets, Germany, France, Italy, whatever, they are still in. So if you look at figures, it's still, you cannot say there is some fragmentation in the market. So this is the advantage of that. I mean, as I said, exemptions, you always have to be very careful that you know it's not only tax law, it's every kind of laws, but yeah, so it's in for the price of having at the end a adoption of the directive. This is like it is compromise. Brussels is called sometimes the famous compromise machine, and this is, I think, one example of that. Then some minor changes in the electronic tax resident certificate. It's we initially proposed that the ETRC has to be issued within 1 day. Yep. Now we have 14. So it's a wish of the member states. I mean, we thought about a system that you push on the button, and then usually if there is no, I would like to say, you know, someone has perhaps 2 or 3 tax or possible tax residencies, these kind of cases may last longer, but the usual case with technical support should be quick. But also here, member states wanted a longer time, and then it's now like it is in the directive. And also the validity period, we had 1 year, now it's max 1 calendar year or the fiscal year, which makes sense in some cases, so no problem with that, I guess. So, but there you see also some small changes with the ETRC. Then another big change was the implementation, and I have to look at the name, this so-called European Certified Financial Intermediaries Portal. This is something, it's connected with the registration because member states said it's super expensive for us to establish a own register. And the idea was to accommodate these concerns that we have a European portal, but the member states are still, and this is an advantage for the stakeholders or for the participants who want to check. It's a so-called single portal, so you go in and then can check if someone is registered or not. But The portal is then sponsored by the Commission, but the member states are still responsible for registering CFIs, and which is very important for removal or rejection, because this is also something where we said at the Commission that has to be in the hands of the member states, because at the Commission you are far away, you cannot decide if someone is on behalf of the member states that someone is within the register or not. Then reporting, one bigger member state already implements a reporting system at the 1st of January 2025, where you don't have the reporting from the CFI directly to the tax administration, but within the chain until there is a withholding tax agent usually, and they collect everything and then report to the tax administration. And this so-called indirect reporting or sequencing or sequential reporting that was also added. This was also a very big move. And I say what I said at the beginning, it depends on the presidencies, because I think the Spanish were not so willing to do that, but then the Belgium accommodated also to that, and then that was then implemented, and that was a very big change on the one hand, but on the other hand, again, also paved the way, I would like to say, to an adoption of the directive. And then two smaller changes afterwards, or one change that we will discuss is the thresholds of 100,000 euro within the decision of the member states. If you want to exclude some transactions, I would like to say, or types of transactions, and one is here the threshold for 100,000 euro that we did not have from the very beginning, but it was first member state proposed 400,000, and then again the typical compromise, because some member states introduced or implemented already 25,000 as a threshold, and then at the end there was then the agreement of 100,000. Then indirect fund structures are now mentioned in Article 13a, which was important because with the definition of registered owner and who is eligible for refund, there were, at the beginning, I would like to say, could have been some problems. And with 13a, I think at least now it seems that it's solved that problem. Then liability is also something which was on the wishes of the member state to have a very general definition. So if there is some breaches, for example, of the reporting obligation and there is a tax loss, then it's on the member state to have some rules, some liability rules, but it's not that you have in the directive certain rules already that you are liable when, for example, there is a strict liability or there is a liability only on intentional behavior or whatever. So this is out of the directive, so a very general rule, but nevertheless an obligation for the member states to implement something. Then entry into force transposition dates, that was also changed. We had 2027, I think, at the beginning. Yeah. Now we have 2030 that it has to be applied, but and this is new, the member states have the obligation then to transpose it already until 2028, to give especially financial intermediaries the time then to see what is...
and that's really important, and that's what we were talking about, the timelines, that then leaves, obviously, that's stating the obvious, a 2-year window from where we've got final requirements to where we have to go live, not just the service providers, but other stakeholders who may have to mobilise. And that's not a huge amount of time. We're going to talk about that more.
But this is also, I think, it makes sense, because that was astonishingly came at the very end of the discussions already. I also I thought that this is something that should have been put into the discussion because for the stakeholders it's very, very or all that have to apply the directive, it's very important. Then follow up. This is what Rebecca also said. I mean, we are very happy that the directive is adopted, but not really, because we have now a so-called general approach, and then for the adoption of the directive, we need to reconsult with the European Parliament. We have anonymity in tax rules. That means the Parliament also only has the big difference to financial services laws, where the Parliament and you have qualified majority, and the Parliament has a very big role in that. But with anonymity, they have to send a report, or they have to be consulted. Then they send a report with their opinion, and that's it. And but now it was the legal opinion, at least until now, that or what we received, that there are so many changes in the directive that the Parliament needs to be reconsulted. But this is a formality. But then you can adopt it, and then you will find the directive also in the official journal, which is not possible before. But what do I say? Why do I say that? For what is it important? Because we have 7 implementing acts in the directive to specify some criteria. Only one example: the electronic tax residence certificate. There, the technical basis needs to be laid down. That will be within a implementing act. And there we, at the moment, discuss, will it be with electronic seals a solution, for example, or are we already going to some blockchain solutions? Because then, I mean, 2030 is far away, and there is already, at the moment, what we heard from our technical colleagues in the Commission, or IT colleagues, that there are already some valid wallet solutions planned, which obviously, I mean, it's not in place, but which is obviously could be in place at the time of when the directive must be applied. So this is something we have to discuss with the member states. Implementing act means that there is also a committee where all these criteria are discussed, and then it's also then published in the official journal with all the criteria. So we have 7.
Just so that the audience understands. So we're now looking to the future lens. So the next priority for the Commission is to finalise, document these 7 implementing acts, which will contain all of the granular detail, one on the electronic certificate of tax residence, one on reporting, etc., etc. So this is to come next.
Yes. And very important, of course, the timing. So the prep work already begins, because usually you can adopt an implementing act when the directive is on the table. So that could be after the reconsultation of the Parliament. But the aim is that, of course, that everyone can work with it to do that as fast as possible. Prep work will begin soon. And but the aim is that, if possible, that already in the next year, not of course in January, but then there is at least most of the rules then on the table. I mean, for the Commission, it's clear that it has to be as fast as possible. And then the work starts more or less after the summer break, I think, and then with prep work, and then as soon as possible the directive is officially adopted, then you can also then draft implementing acts as a rule, and then start with the adoption again when we are fine with that.
That's really helpful, Frederek. Thank you. And I think what's also reassuring is that there's clearly an understanding and an acknowledgement on the part of the Commission just what a Herculean task the next few years are going to bring for those of us in this withholding tax ecosystem in Europe. But really, the work is just starting now, or about to start now in earnest. We have obviously yet to see and appreciate the Commission understand this is a priority, the final implementing acts. We also then need to see what the effect of the member states' transposition exercises, as always with the new directive, by the time at which the jurisdictions enshrine into their domestic legislation the principles that they're mandated to. The concern is, I'm going to talk about this now with the panel, is that there will be fragmentation again, which is obviously what nobody wants, including the Commission. The whole point of this is standardisation. So we have discussed between us what we think some of the more pertinent topics, or the topics that have come up quite a bit over the journey of FASTA so far. So we're going to talk about them now, and if we start maybe with the fragmentation point, fragmentation versus not. And a few of us have made this observation, Steffen, that whether by fate or design, Germany seemed to be ahead of the curve in terms of, are they there already with their MiCADIV reporting, everything that's coming and happening now under the German Modernisation Act. There's been a lot of commentary, certainly in the industry forums that we attend, as to what the nexus will be between what Germany are doing and how that will mould and mesh with FASTA.
I would say that the Germans are implementing already now something that is quite similar to what is foreseen here. The FASTA directive has additional elements. For example, the certificate, which the German rules don't have right now. But in that respect, I would not say that Germany would cause fragmentation. So I think they are ahead of the curve.
They are, I think.
Yes.
And on the certificate of tax residence as well, again, there's been a lot of push to emphasise the need for standardisation. Those of us who handle these sorts of documents day in, day out know today there are, however, nuances, but it's helpful that the directive is, for example, stating there need to be references to specific treaties that might be applicable. Does it go far enough? We know that there are some certificates of residence which actually name investors and so forth and so forth. But I think the inclusion of referable treaties is definitely going to be useful. Len, you had some views when we were talking about this as it relates to the US and their ambitions in the COTR space.
Yeah, so speaking from the US, I'm incredibly jealous of the certification of residency because we live in the world of 6166s and very long and arduous processes to request those from the IRS. I think across Europe, if there is fragmentation as the different countries put different laws in place as they're supposed to, and as always said, are they going to be allowed essentially to legislate away from honoring double taxation treaties, which I think could be a possibility. The certificate of residency harmonization will be a huge benefit. There are markets now where you can go and request direct certificates of residency like the 6166, and then there are other markets where you actually have to, in fact, file the claim to that tax authority for them to certify that the claimant is a resident, for them to either forward on to the next tax authority or to send back so that it can be submitted. So there are a multitude of processes around this, which I think, if that's the first thing to come out of this, it will be the best. Hopefully Germany will kind of get on board with that. I was hoping, Steffen, you were going to say that the Germans are going to start paying reclaims. But no, I think that the certificate of residency step will be a big one anyway. I was interested to hear Frederek's thoughts on blockchain, and we've kind of marveled about some of those things and how far will technology go over the next several years to kind of to facilitate some of these things. And
we'll talk about the technology in a minute, I think. The other area that there's been a fair bit of noise about, not in a negative way, I think, because we've sort of got used to it over the last years as an industry, is the holding period. So we know under the directive that in order to access the faster relief regime, there's a stipulation that the asset has to have been held for 5 days prior to X. That used to be 2, didn't it, Frederek? And that was one of the things that moved. So the first thing to say on that, I think we'll agree, is there's going to be a fairly substantial effort, if only from a technology and a process perspective, never mind anything else, for the industry to get ready to capture that holding period requirement. So that's one thing. I think the other interesting thing is, in a scenario when FASTA comes into being, 2030 onwards, where an investor fails that holding period, then you are back into the default, normal world of tax reclaims, to the extent the source jurisdiction has a reclaim mode of relief. And then we are back to where we are today. I'm not saying this is a good thing or a bad thing, and which we've been grappling with for the last 2+ years, Paddy, which are holding period rules. So we've got Germany, we've got Belgium, we've now got Austria, and none of them are identical, by the way, far from it. We were talking about the fact that a lot of the US treaties have, US-Sweden have specific. So we're going to be, and again, I say this, I'm not saying this is a good thing or a bad thing, in a sort of bifurcated twofold holding period world. And that's just the way we're going to live. Views on that, Paddy, on the holding period?
Not just on the holding period, and if I may just meander for 2 seconds, that could probably contradict me. I wasn't meant to be dressed like the Backstreet Boys today, but I had a fight with a cup of coffee this morning.
You don't have to tell everyone this,
Paddy.
But
you'll tell me the opposite, so just to be clear. And I did say I would be balanced, so maybe start with the constructive, and then we'll get towards the balance when I think of what it is. So not just on the holding period, but if you look at it, like the 3 aims were improve the capital markets union, reduce fraud if possible, make things more simple and harmonised. Will it do that? Let's see, right? Right now, we're battling with different regimes, it's a bit of fragmentation, different documentation, etc. It's difficult, but it's a known difficult. We know what to do now. We know it's kind of bread and butter for most of us. What could happen here is that if implemented across all the member states in the way it originally intended in your draft 0, fantastic. We're at draft 10. And you went through some of the differences, and some of the differences are the exemptions, right? You've got the 5-day holding period. If someone has a reduced rate of withholding tax that they want, then they fall out. If they have a 0 withholding tax, they fall out. If there's financial arrangements, they fall out. If there's over 100,000 payment in certain scenarios, they fall out. So with all of that, you could end up with, yes, there is some harmonisation across maybe 8 countries. Is it 8 that we said that's above the 1.5% cap? Roughly
I
8?
thought there were 10.
No, in between 10, it depends on how you calculate, but between 10 and 11 are in.
Okay. So that 10, then there's the rest of the 27. And then also they can decide if certain arrangements don't fall within that as well, and they go back to the standard relief. So you could end up with, again, another series of a lot of fragmentation and a lot of money now being spent, and you can talk about that later for the custodians, on trying to get technology in place to actually deal with this, because there's a lot of liability that are placed on you guys.
Yes.
But there, perhaps if I can say two things. First of all, at the end, if you look at the landscape for withholding tax and reclaims, we already have a fragmented framework. Because why? We have 4 member states, they don't apply any withholding tax, they fall out anyway. And then you have, I don't know, also 4 or 5, I think, member states, they have such a low domestic rate.
Yeah.
So if you have usually in the double tax treaties 15%, so you have never ever...
There's no further reduction under any treaties. Yeah.
So this is one thing that you have to take into consideration when you talk about fragmentation. It's never good, but this is something where, I mean, this is the situation we face. The second thing is what Patty said is important, but you have to, with the exclusions, because you mentioned them with 100,000 euro threshold and so on, it's a may rule. So that means member states may do it, but if member states say, and we always mentioned it as a risk appetite, if member states say we are fully fine with everything, you don't need to apply anything of that. So yeah, fragmentation, yes, but this is what I said at the beginning. You need to give at least the possibility for the member states to have safeguards to tackle abuse, tax abuse, and all these arrangements which are linked to that. But they may not do it. They must not do it, I would say. They may do it. So this is very important to know because, it depends on the member states then. And if someone has a relief source with 10 cases a year, then they say, why should I implement any administrative safeguards or whatever? Then it remains like it is. So this is a little bit the thinking behind. But you have to give something the member states a toolbox, so to say. What they choose, it's on them.
It's fair. No, it's fair. And what I will say is it's to be balanced, not just I'm sitting beside you and I'm afraid of that. On the flip side of things, when you look at draft 0, and especially with the Spanish presidency and Belgian presidency, they were very accommodating in listening to the financial services industry, especially the investment management industry, and introducing concepts of collective investment schemes that are transparent, where actually the actual legal owner is not the person who's entitled to relief. So on the balancing side, there was a real aim to try and make things simpler. I won't go into this, maybe you can say it later or others afterwards with the drinks, but it seems that by draft 10, it was a very political document rather than what the original document set out to be.
Yeah, but we have to see, for example, with the transparent funds, I think this is really an improvement because I think there was something, or that was input, that there could be situations, I mean, I think you know them from your practice, that then you have, there are, I would like to say arrangements or structures, perhaps, better said, where someone is perhaps entitled, but is then not entitled to at least to get to the fast track procedure. And this is something which we don't want, because it's again the enhancement of the improvement of capital markets, union, and then it would be, I would like to say, crazy if really usual structures which are day-to-day work for you will fall out of that. I mean, this is also something, and I think with these transparent funds and the look-through, I would like to say, structure which we have now, especially in Article 13A, I think that this is indeed an improvement. Is it a political decision at the end? Yes, but as I said, I mean, the thing is we are coming from very opposite directions. And that will be, at the end, a compromise like you used to, perhaps from Brussels, that was clear from the very beginning at the end.
Yeah.
But you see that, yeah, I mean, the Commission also had red lines that were not crossed. But, I mean, I would like to say, for example, for us, the first exclusion of the scope itself, which was proposed by the by the Spanish presidency at the end of, I would like to say, November, or when it was, that was difficult to swallow, I would like to say. So it's not that you say, okay, great, now let's move on, then we get an adoption at the ECOFIN. So yeah, political at the end, of course, yes. But I would like to say with a lot of improvements, not only for the sake of an adoption.
Yeah. Do you want to say that?
The journey is not over yet, and we will see how this develops, but I would make the prognosis that potentially this new rule set, it may lead to a fragmentation other than we think. I would like to say for simple cases, let's say a long-only physically invested investment fund, and there are many of them, and there are large amounts of withholding tax that are suffered by such vehicles. This new rule set could significantly ease the process and make it much quicker. And maybe even, because we were talking about digitalization, because of the standardization of the processes, the data fields, it may lead to a very digitalized reclaim process in the future, especially if all of the tax authorities, the local tax authorities are also following the same processes. But on the other hand, there may be cases where such a digitalization is not feasible and where handmade work, for example, by tax advisors is still required. So it's not so much...
There's always going to be a need for tax advisors, Steffen. There'll always be a need for tax advisors.
So it's not so much a fragmentation by jurisdictions, but maybe by types of cases of taxpayers, so to speak.
And I think this, and we talked about this indirect point, this push to look through certain vehicles, transparent vehicles, is not a new concept. We've been knowing this has been coming in some form for a while. You know, testing what the underlying composition is of a seemingly, whether it's opaque or transparent fund structure in order to avail of treaty relief, has been coming. From the services perspective, from my perspective, it's always been challenging providing relief where you're looking through multiple layers of potential beneficiaries. It's very prone to risk. It requires a substantial amount of non-standard technology and technology development. And so historically, that service provision generally across the custodian houses has been more limited. So maybe that's going to have to change. And then also there's consideration as to what's going to be deemed look-through. I mean, we you know, there are certain vehicles today that we know are constructed as such, deliberately so, contractual funds, etc. But there are many other fund types, as you and I know, Steffen, you know, partnerships, special funds, etc., who've lived in a hybrid existence for many years because there simply might not be the equivalent understanding of what their legal entity structure is in the various source jurisdictions. So you have to run comparability arguments, it's not straightforward, it's not linear, etc. So I think there is a lot more to come, and I think, again, and I'll probably say this a lot, the member states' definitions and clarifications around this sort of thing is going to be helpful.
Yeah, Rebecca, you mentioned a couple of statistics when we started. I think it was 70% of wealth management retail investors don't get access or don't receive their full entitlements because it's such an arduous process. You have to think about a lot of those investors invest through a trust of some sort. And trusts, depending on the market, to your point about definitions across jurisdictions, that's a really important point, because if you as the custodian can't grant them relief at source, unless you're totally assured of who the underlying beneficiaries are of the trust, and then how do you manage that annually, right, so that you can get the certifications of residency and so forth, and in order, the custodians by and large won't take that risk, and then they're back in the long form process where they are today, and 70% of them still won't be getting their money. So, I think the point of, yes, large investment funds, perhaps defined investment funds where it's a lot of pensions or a lot of institutional investors, or pools of classes of retail investors perhaps in a UCITS or something similar. Yes, this may work, but there's a big growth in wealth management, particularly across Europe. There's big growth in the private funds community, and so I don't know if it's 80-20 today in terms of assets and entitlements, but my guess is that will continue to shift in favor of these smaller and, call them transparent broadly types of entities and investors, or the ones where it's, they're coming in perhaps through an omnibus account in a separate institution, where flowing the certifications and other information up the chain in time to get relief at source may also prove difficult. So that's you may solve for one and further fragment the other, right?
May I ask Len a question?
Please.
Len, you're servicing a US mutual fund, right? That's comparable to, I know, somehow LuxICAV, an Irish OIC, whatever, or an Irish ICAV, whatever.
Yeah.
How are you feeling now that that US fund might not be able to access the faster procedures while that comparable LuxICAV can, and it's going to get paid within 60 days, otherwise potentially interest, etc. And most of the time, the US mutual funds are holding way more than 100,000 on a dividend payment. So how are you feeling now? You're servicing the US fund.
I don't actually think that for the broad swath of U.S. funds, based on my read of Faster, that it's going to change, right? They have access in, I think, 7 of the markets to relief at source, France, Spain, Italy.
If the dividend payment is under 100,000.
But that's also subject to, and that 100,000 may be split up amongst the investors, right? The question is, will the Swiss rule apply, right? And will the tax authorities come back and say, we want to know who all of the holders are, which would then make, essentially a corporate fund transparent for that purpose, and that would create an impossibility around this. I don't think that's going to happen. I don't think that's the Commission's intent here. I don't think they're looking to make it harder for what's probably the largest segment of investors into Europe and any other place in the world, right? The U.S. registered funds industry. So I think that one will get solved, my personal view. I don't know, Frederek may have a thought on that, but I don't think that's going to be the issue.
Well, what you say, I mean, at the end, if you want to attract capital, I mean, you cannot exclude some
Right.
certain, I would like to say, fund structures. But what is, of course, also, because Rebecca said it, I mean, we don't know what kind of structures you have in 2 years or whatever. So, but yeah, you're fully right. I mean, for the sake of the Capital Markets Union, it is to attract capital for the EU, of course. And then I think if you have to interpret then the rules, I think that you always have to keep in mind.
I do think, though, it's everything else that's going to be the problem, because they're all essentially exceptions, right?
We were speaking much about trust already earlier, trust lost and maybe trust regained. Ms. Willmott, maybe a question. We are looking into the future. For you, a question. We are looking into the future here, because in the end it's 2028 or 2030, and what happens, and am I still alive then, and whatnot. Could it not be an idea for, or maybe it's not at all feasible because the interests are too divergent here, could the industry not approach the Commission with a proposal for, folks, let's agree on that this is a simple case.
You're talking about for the complex fund.
Or for the complex ones, but I mean, the interest should be that at least the simple cases should be should zip through the machinery, hopefully easily, and one could propose UCITS funds. We guarantee you there's no securities lending. whatever other criteria there may be
Yeah.
over and above what is mentioned directly in the directive. So it could be a cooperation.
Yes, I suspect, and my expectation is, as more detail starts coming to the fore over the next 2 to 3 years, there will be more clarity on what those pinch points and pain points are going to be, and there absolutely will be, what would you call it, an industry voice as required, to talk to the Commission, to talk to our other stakeholders in the chain, get the views, etc. I mean, there is, this directive, and I absolutely did not want it to sound like poor service provider when I was intentional on that when I agreed to do this panel. But there is, undoubtedly a huge implication from a technology perspective, from a resource perspective, from a liability perspective on the service provider. So I think that will drive a desire for pragmatism and standardisation where it might not otherwise be appearing to be. Once we see all the details come to the fore, that will absolutely drive the industry to do that.
Oh, and that's actually one of the concerns as an ASNR that we have, is that something that is considered normal today might not be normal tomorrow, or the costs that are associated with that go up, which goes kind of against what we're trying to achieve for encouraging retail investors to invest in the capital markets union. And the concern we have is, that service providers like yourselves won't be able to offer the same services in certain markets, that the costs will go up for compliance, which means that's actually bad for the end investor, which is going to discourage investment from retail. While I think that overall the goal that was originally set out is definitely a valid one, and we're hoping to get there, it really depends on how all this is implemented as we go, and it is going to take a lot of work from the industry bodies to get that voice across.
And within our own shops as well. I mean, and let's just talk about the liability point, I guess, because it's the elephant in the room, which has been sort of concerning the service providers to date. And firstly, I think it's too early to tell. And I know I keep saying that, it's not an excuse, but I think it is a bit too early to tell because of all of this detail we need still to come through, where we're going to end up. And I think that, there's questions out there that we're already asking each other whether one could get comfortable with the new liability response, which, by the way, isn't new. As you know, Steffen, we've already started experiencing that with the new German Act. In the Netherlands, it's the same thing. So this is a recent rising trend. So maybe we would already have had to tackle it one way or the other, whether it be via FAST or other. Whether we can get comfortable in a clawback situation for our contractual and commercial arrangements is a question for the custodians. That gets you to a point. That gets you to potentially financial mitigation. It doesn't get you to reputational mitigation of risk. Which I do think is very helpful, Frederek, the directive mandates for the beneficiaries and the investors to provide this absolute declaration that they are the true beneficiary and they absolutely have entitlement. So in a situation down the line, let's hope we don't go there, where there was an argument that something was in contention, applying reasonableness to the situation if we have done our due diligence and got that declaration would seem to mitigate the risk as well. And then I think it's about how, over the next few months, a couple of years, the service providers can get their arms around and get comfortable with what we're being asked to do from a due diligence perspective. Because I believe if we do the due diligence, we understand the due diligence, we do it properly, and we can evidence we've done it properly, then in combination, any possible contention should, again, be a reasonable discussion. I just don't think we're there yet. How are we going to validate all this electronics? How are we going to manage the 5-day holding period? How are we going to identify financial arrangement? It's just too many unknowns. But my concluding point on this, Paddy, you're absolutely right, is, and we understand this, is where does all that mean we're going to end up from a servicing provision perspective? That's the question.
And do you think, maybe this is one for you, Dr. Schuska, did you
I
think
don't know
there was
who's
an
moderating now.
opportunity? Do you think there was an opportunity? Sorry, this one came in. Do you think there was an opportunity to address beneficial owner? Because I know we tried to do it by introducing the concept of a registered owner and really avoid beneficial owner all throughout, but it popped back in at the end.
Yeah, it popped up in the end, but the thing is, indeed, if you look at the, I would like to say, history of to try to define beneficial ownership, it is also at the OECD level, it was tried, and our thinking was that we first rely on that registered owner definition, which is not meant that at the end, when FASO will evolve perhaps in some years, that the definition of beneficial ownership could be, or that there is another try to define that. But you're right, in that directive, it was not, because the thing was also in terms of timing, that if we start to define beneficial ownership, where we had, as I said, many tries before, that then we will not come to an end relatively quickly. This, I mean, that it comes then, or that there are references, for example, to double tax treaties, where then in the model convention, of course, beneficial ownership is part of it, and also some sort of definition. Yeah, that's right. But we did not, there was no try to, or no attempt, I would like to say, to have the definition in the directive now, which does not mean that the Commission will try to go in that direction at a later stage, but not now. That's right.
Can I just quickly say, regaining my position as moderator, we have just 5 minutes left, and I want to give each of you a chance to give closing statements. I thought I might start, if that's okay with all of you, because we haven't covered the technology and data piece. So just in brief, and I'm going to split this into the electronic certificates of tax residence and the reporting, and this is from the service provider's perspective. With the electronic certificates of residence, the interesting thing will be how prepared the service providers are to handle digital documentation. There's a variety of different stages that service providers are at. So how to consume, hold, process, record is one thing. And that's important, we don't know, and a lot of that granular technology detail is not barcoding, etc., is not out there yet. And then we also need to understand, that's the internal view. The external view is how are we actually going to connect the pipes with the tax authorities in order to have the passing back and forth of electronic certificates. And presumably there'll be a variation across member states. So all of that's going to need a substantive amount, I guess, of appropriate resource, dollars, to solution, build requirements, as well as trying to keep your expense line down, avoid technical debt, etc. Same with the reporting. We've all lived, many of us have lived through years of schema before. You know, this is where data, robust data governance is key. I think Graham was saying that earlier actually on the technology panel, and I absolutely agree. And as the holders of the CBOR and the ABOR, the custody book of record and the accounting book of record, the service providers expect to have the majority of those data attributes. But it's how you can easily identify them, extract, transfer, load, drop them into the relevant fields and the relevant schemas. Presumably there's going to be a variety of schema fields to a greater or less extent between the jurisdictions. Then it becomes a bit more complicated. And we need to see how all of that pans out. And so I think, you know, whilst data governance is high on all of the corporations' agendas, until we see what those actual requirements are, you won't be able to identify data gaps, you won't be able to do any solutioning. But do you want to go next, Paddy? I just want to make sure everyone gets in a final word, and then I'll just close.
My closing is actually just a thank you. It's more a thank you to Dr. Schuska. It's not very easy to start drafting a directive like that with all the different interests of the different parties, with all the different member states having a different opinion on the journey, and ending up where we are was a difficult exercise. We have something, let's see how it plays out, but I thank you for trying to get us there, and I'm sure we'll see some benefits at the end.
I agree, and I think there's been, the industry recognised, and I said this to you before, Frederek, that there's absolutely been transparency on timeline status and a willingness to listen to the industry throughout the faster journey, which hasn't always happened.
Thank you.
Do you want to say anything more before we close?
Well, that was so nice. I mean, what could I say?
Leave on a high. Leave on a high. I'm with you.
I'm already. Thanks a lot. I mean, I think the discussion showed that there is the directive is seen, and that's my takeaway, positive, which is very good. But of course, there are still some things where we have to work on, which is clear, and with the implementing acts, there is the chance, I would like to say, to specify the things in a way that you can work with it. And but with the implementing acts, as I said, there is a committee, and I think at the end, hopefully, then there will be something on the table that everything runs smoothly. And the smaller cases, of course, but hopefully that the whole, if you see look at the directive, that of course every investor then at the end has the advantages we try to achieve. So positive takeaways, and but there's some work.
Takeaways. I agree.
But
Thank
some work to do. Yeah.
Yeah. Yeah. Steffen, Len.
Oh, please.
No, please, Mr.
Yeah, so I'll make one suggestion, and then I have a couple of comments. But beneficial ownership has almost a radioactive quality to it, the third rail, right? But I would propose, there were a couple of new acronyms in the faster proposal. I would propose one more, EP, entitled party, and perhaps something to think about as you go through into the detail. Politics is the art of the possible. I think that you absolutely, Dr. Schuska, deserve congratulations and accolades for how far you've been able to take this. I've been at GlobeTax for 20 years, and I've watched these series of different working groups try to work on these things. I think the fact that you have been able to help isolate and condense some of the issues by taking it from 27 or 28 member states down to 10 or 11, which are fundamentally the entire capital market of Europe anyway, by trying to hive off in different sections different types of investors, you've created a path to getting some successes here. The electronic certification of residencies, I think, will be a huge benefit to everyone. And I don't think there's much conflict, right, in getting it there. And so I think there's a couple of other points. This is not going to be perfect, no tax movement ever is, but I think in contrast to some of the OECD stuff now moving to the UN, where it's clear to me at least that almost nothing's going to happen for a very long time, that congratulations and thank you. So.
Steffen.
Yeah, Dr. Schuska, you were in the machine room of tax law, which in the end is politics and very fragmented, and it's difficult to get this done. I think it's an interesting piece of regulation because it goes from very standardized cases to still very unique single financial arrangement cases. Interesting how this will work out. And overall, I would like to refer back to Mr. Kazimi this morning. It's just money. It's just tax law. I'm happy that I'm not in the business of war. It's just money. So in the end, we'll get it.
Well, on that happy note, we'll finish there. Thank you very much, panel. Thank you.